Welcome back to Yahoo Finance Live. We're still live at the Goldman Sachs Tech and Media Conference in San Francisco. And the other undercurrent at this conference is, in fact, all things happening in media. Lots of focus, of course, on AI, but that other undercurrent is media and what may be happening next. And to that end, Brett Feldman is here, Goldman Sachs Managing Director covering telecom, cable, and media. Thanks for having us to your conference, Brett. We appreciate it.
We're so excited to have you here. This is one of the biggest events we do all year. We're going to have the senior leaders and CEOs from over 200 global TMT companies. It really should be a great couple of days.
No, it's already shaping up to be that way. And a lot of the chatter in the room is the situation between Charter and Disney. And my question to you is why is this happening right now?
That's right. So just for your viewers who I think probably know by this point in time, if you're a Charter customer, so if you have Spectrum Cable, you can't get any Disney channels right now. They've been removed from the service, and that includes ESPN. So you made a great point. We have been seeing the number of households that pay for cable and satellite TV bundles decline for years. Why are we now just getting to this point where the distributors, the cable companies, are really pushing back? There's really two reasons why. The first is we're going to see the total number of households that pay for TV this year decline by about 6 to 7%. About 2 years ago, that was negative 5%. A couple years before that, it was a much more moderate number. So this has been an accelerating pace of decline. The reason why 6 to 7% is interesting is that historically the media companies like Disney, have been able to raise the price of their channels by about 5 to 6% per year. So we've hit this tipping point now where the media companies simply can't raise prices fast enough to offset the loss of pay TV subscribers. I think that has emboldened the cable companies to look at this relationship and say, listen, we can't absorb these historical price increases. We need to talk about a new model. That's one of the things that Charter talked about. Another point Charter made is a point we actually started making about 4 years ago, which is that they've reached what they call a point of economic indifference. Basically, they're saying we almost don't care anymore whether our customers decide to pay for a channel package or not, because they've lost so much profitability in that business as a result of cord cutting. They really make all their money now providing internet service. And so I think that you have the cable companies saying, we can't do this anymore. We were able to deal with it for a couple of years when we were losing a small number of customers. But as this snowball continues to roll down the hill, we have to come up with a new model.
At the end of the day, when this comes to an end, and it inevitably will, who is the biggest loser? And what does it mean to the broader media landscape?
It's a great question, and actually we're going to be asking a version of that question to all these CEOs of the big media and cable companies when they're here this week. And really the question we're going to be trying to get an answer to is, what's a win-win? If the model that we've had before, the relationship between the media companies, between the cable and satellite companies, and the relationship that they ultimately have with their viewers, if that's not working anymore, what is going to work? And are there other things that have to change? Maybe the way they price their streaming services in order to get something that works for everyone involved, including the consumer.
Do you agree? I think it was last week, Barry Diller at IAC said the streaming companies, they're not your friends. They're your enemies. Is the ultimate problem here companies like a Netflix?
I think Charter has been trying to make that point. Their view is that the media companies have devalued their entertainment by moving on to streaming platforms. And they give examples of it. They say, historically, you've been able to capture some of that value through advertising. You're barely doing any advertising on your streaming platforms. It's a new thing and you're not doing a lot of it. There's no security. It used to be that if you wanted to watch what was on cable TV, you had to pay for cable TV in your home. I think we all know that password sharing has become a big deal. Netflix has recently started cracking down on that, but not all the media companies have. And just in general, I think that the distributors, the cable and satellite companies, they look at what they're being asked to pay to make that content available to their customers, and they look at the price that those same media companies are charging to make it available on a direct basis. They say these are not the same prices. There's got to be a way that we come up with a sustainable economic model we can all agree on.
Is there any appetite to own these media stocks, and what has to happen?
Well, I think there is, in part because they've been under so much pressure. A stock that we have talked a lot about is Warner Brothers Discovery. David Zaslav, the CEO of Warner Brothers Discovery, will be here tomorrow. They are able to do something that some of the other media companies cannot, which is that they're still integrating a very large merger. They had acquired the Time Warner assets, the old Time Warner assets out of AT&T about 2 years ago, and they quickly realized there was a lot of inefficiency in how that business was run. And so they have an opportunity here to keep taking costs out of the business and hopefully make the products better at the same time so that they can generate cash, they can pay down debt, and ultimately do something that should be accretive to their shareholders by positioning the company to be a winner in the streaming wars. But to be fair, it's a highly debated sector. That's a highly debated stock.
Not lost on me, Brett, is last year Bob Chapek was here, now former CEO of Disney. Disney CEO Bob Iger is not here. Of course, there's always scheduling conflicts, et cetera, but to me, I think it says a lot that Disney's not at this premier conference, and it says a lot about the challenges they're going through. What has to happen to get investor appetite back into a stock that's about 52-week lows, despite the content power that is Disney?
Well, Disney's been here for a number of years, and so it would have been great if we could have made the scheduling work, but hopefully we'll have Bob Iger back. There's a few things they have to do. They have to demonstrate that they can continue to be on a path to profitability in streaming. So one of the nice inflections that we've seen since Bob Iger returned is that the losses they've been incurring in their streaming business have begun to compress very significantly. So proving that they can make money and then give some indication as to what those margins can be over time, I think that's really important. I think in their traditional media networks business, which really revolves around ESPN, they have to show that they can transition ESPN from being a package of cable and satellite TV channels to being something that you can subscribe to on a direct basis, meaning something you could stream. A lot of people may say, well, hold on, can't you get ESPN Plus right now? You get that in your bundle with Disney Plus. It's not the same thing. It's a niche product. They haven't put the full suite of sports rights that they have access to into that product. If they can do those two things, they will really be able to demonstrate that they have a strategy and a model for taking what is a very profitable, historically very profitable media business and turning it into a profitable streaming media business.
I mean, Bob made a lot of headlines a couple months ago suggesting everything was on the table. What's the end game here for him? Is it a spin-off of ESPN? Is it a sale of those linear TV assets?
I don't think we know. I thought what was refreshing about those comments, I think some people heard him as a little bit alarming, but I think that what was refreshing was to hear him acknowledge that everything is on the table. If you go back a few years when cord cutting wasn't quite as intense as it is right now, in some cases you would hear media companies talk about this being manageable, taking a very long time, not likely to get any worse. I think investors were always very skeptical of that. To hear a leader in the industry like Bob Iger acknowledge that you have to put everything on the table right now, I think shows how seriously they're taking this and is a real signal to the street that they're going to do what they need to do so that Disney can have another 100 years of success in the market.
Are investors waiting for that big move to get back into the stock? Do they want to see him pull the trigger on something mind-blowing?
I don't know if it's one thing. I think you have to look at this and say, as he's returned to the company, he has made the adjustments that are necessary to put the company on the path they need to be on. Because what investors really want is they want to see a company that can execute its way to success. And if you're still debating what they're supposed to do, that can be an overhang on the stock. So the main thing is setting a strategy and then setting a strategy that the market thinks will work if you execute it.
Along the lines of Disney at a 52-week low, I look at Paramount. You still rate the stock a sell, right? What has to happen to get investors excited about that name?
Paramount faces a lot of the same issues that Disney faces, a lot of the same issues that Warner Brothers Discovery faces. One of the things that they are very committed to is continuing to invest in their streaming platform. So whereas many of the other media companies have already moved past peak investment, meaning that they're getting closer to breaking even, not farther away, this year, Paramount will probably see their peak losses, meaning they're still leaning into the investment. To their credit, the service has been much more popular with viewers than I think a lot of people guessed. And they've had some real hits. They've put the NFL on the platform. So I think they feel very good about the subscriber momentum. What they have to be able to demonstrate to investors is that they can not only pivot away from being in an investment phase, but accelerate towards making money in their streaming business because they, just like everyone else, are going to see their legacy networks come under increasing pressure.
Brett Feldman, Goldman Sachs Managing Director, covering telecom, cable, and media. Thank you for having us at your conference. This is one of our favorite ones by far.
Oh, thanks for being here.